Today, Evergrande still haunts the house. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. Well, Chinese property firms listed in Hong Kong face a March 31 deadline to file annual results, their first audited financial statements since the industry's liquidity crisis spread. Transparency and governance concerns have cropped up alongside worries about developers' ability to repay debt following a record number of defaults last year. In fact, about 40% of bond defaults are sitting in the property development sector. Evergrande and its 2 Hong Kong listed units this week have joined a handful of Chinese developers warning they will probably miss those deadlines for reporting audited 2021 results. And separately, its property services unit said it was looking into how $2.1 billion of its deposits were used as security for pledge guarantees and seized by banks. Evergrande and its 2 Hong Kong listed units do expect to delay publishing the results by March 31 because audit work hasn't been completed, according to a stock exchange filing. Sunac China Holdings Limited and Shimo Group Holdings Limited issued similar statements too. The companies blamed the latest COVID-19 wave in China for the delays, while Evergrande also said drastic changes in the operating environment added to audit procedures. Shimo and Sunac plan to release unaudited 2021 results on March 31. Evergrande said it will publish audited results as soon as practical after audit procedures are completed, and issue a separate statement to inform investors of its expected results release date. Evergrande also announced plans to appoint King & Wood Mallesons as an additional legal advisor to handle debt risks. The firm's risk management committee is actively looking for solutions and communicating with its creditors, the company said. The company's shares were suspended on Monday, pending an announcement containing inside information. Sunac said that due to the restrictions on travel, logistics and others in mainland China and Hong Kong as a result of the recent COVID-19 pandemic, the audit procedures of the group could not be completed as scheduled. And in a separate statement, Sunac said it expects 2021 profits to fall about 85% due to factors including the sector's challenges in the second half of last year. And S&P Global Ratings have withdrawn its long-term issuer credit score on Sunac China Holdings Limited at the company's request, according to a statement released on Wednesday, which is the latest indication of distressed financials among developers. Sunac's 5.6% yuan bond, due 2025, briefly halted trading after plunging by 20%. And meanwhile, a separate Sunac local currency note reversed some of its record day earlier slump after the developer's key onshore unit proposed a schedule to fulfill repayment obligations. Chinese high-yield dollar bonds dropped 0.5 to 1% on the dollar on Thursday, according to credit traders. And the Bloomberg Intelligence Index of developers' shares fell as much as 1.4% after gaining on the previous 2 days. Shimo said its audit processes have been affected by certain management and employees being placed under quarantine during the latest COVID wave. And the company also said there had been a delay in obtaining certain external confirmations from third parties for the audit. Shimo estimates audited annual results will be published on or before April the 30th. Its onshore unit said in January that it was changing its auditor for the first time in 27 years. And Roseshine China Holdings Limited said on Monday that it won't file audited results by March 31, and it too said its processes were affected by COVID impacts. Accountants PricewaterhouseCoopers was unable to complete its work partly because the supply of requested information had fallen behind schedule, they said, and the firm resigned. That came after at least 4 other auditors resigned or were replaced by builders since the start of this year. Now, firms listed on the Hong Kong Stock Exchange typically see their shares halted if they're unable to release audited annual figures 3 months after their fiscal year ends. Dozens of companies' stocks had trading stopped on April the 1st, 2021 for not meeting those requirements. But firms that release preliminary results by March 31 and show COVID-related issues in finalising audit work can get an extension to avoid a trading halt. Companies still need to file their annual reports by April the 30th to prevent a possible trading suspension according to the exchange listing rules. And yet more broadly, China Evergrande Group has assured investors that it was on track to provide creditors with a preliminary restructuring proposal by the end of July and urged patience. The developer asked investors in a call on Tuesday evening in Hong Kong not to take aggressive action so it can proceed with its holistic plan for all creditors. And a company executive emphasised Evergrande would seek to strengthen communication with them. Evergrande and its team have so far been in contact with 89 offshore institutions and individual investors to exchange views with them, the company said. Investors are closely watching Evergrande, the world's most indebted developer, after it defaulted on dollar bond payments in December and said in January that it aimed to issue a preliminary restructuring plan in the next 6 months. The firm's debt restructuring is expected to be among China's largest and most complex. The company has $22.7 billion in offshore debt, including $3.3 billion in the form of project financing and private debt. And stock trading for Evergrande and 2 listed units were suspended in Hong Kong starting Monday, pending an announcement containing, quote, inside information, according to exchange filings that didn't actually give you any further information. For its part, Evergrande said drastic changes in the operating environment added to its audited procedures. And investors in China Evergrande Group are still in the dark over just how $2.1 billion of deposits at its property services unit came to be used as security for pledge guarantees and was subsequently seized by banks. In a call with investors late on Tuesday, the developer's officials reiterated comments from earlier filings that they were investigating the matter without sharing fresh details. The third-party pledge guarantee wipes out most of Evergrande Property Services Group's cash holdings. It's peculiar because investors expect Evergrande management should be aware of where the cash went, rather than instead setting up an investigation committee to find out, said Bloomberg intelligence analyst Andrew Chan. While the 13.4 billion yuan or $2.1 billion in seized cash is small in the context of the broader restructuring, it raises questions over the reliability of the financial accounts of the services unit if the group plans to sell it at a good price to achieve maximum recovery for creditors, Chan said. And Evergrande creditors are keeping a close eye on the beleaguered developer as it embarks on a debt restructuring that's likely to be among China's largest and most complex. Worries over transparency have surfaced repeatedly as Chinese developers struggle to cope with a credit crunch that swept the sector as Beijing clamps down on excessive borrowing. So the long, slow fuse on China Evergrande continues to burn. The more you hear about it, the more questions I have about what is really going on. Just remember, the property sector in China is huge, and if it does go pear-shaped, the consequences will be significant, and not just in China, but more broadly in the financial system. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.